Inflation came down a bit in February, but it's still too high and the war will make it worse.
The worst is yet to come for Australian households.
Inflation could soar above 5%.
Well, the Reserve Bank is this morning warning a recession may be the only way.
Sentiment's changing globally. No one's immune. So we've got our war driving prices of fuel, and that has huge implications for food, goods, water. So inflation is going to rise. The only lever our RBA can pull is interest rates. We don't have a housing crisis, Reece. We've got a migration crisis. 57,000 people arrived in Australia in January 2026, the highest ever recorded in history. We've got a government and they're not doing anything to bring on any supply, Reece. Look at Darwin.
Darwin actually completely came off a cliff, 0.2%.
In the last 7 days, homeowner numbers have halved. So these markets quickly change on the back of sentiment.
Perth leading the way, 2.3%. Sydney and Melbourne not seeing any growth. Do you see the sentiment changing in the next couple of months?
The pendulum has shifted. You want to be greedy when those are fearful. History would tell us this is a better time to buy. Have some power in the negotiation.
You're listening to the Follio Property Podcast. I'm Reece and I'm here each week with my co-host Lachlan Delahunty. Lachlan, we did the value add strategy a couple of weeks back now. Loads of positive comments, a lot of feedback on that one. Do you want to just talk through some of the feedback that's come across your desk?
Yeah, because I think it's such a broad topic, Reece, because value add is anything from subdivision through to, the 500 different ways you can renovate a house or add value to a house. So hard to sort of cover off on every individual question in terms of every sort of listener's personal situation. So those that want to understand what this looks like, we call it the VAS strategy. Just comment VAS in Spotify or YouTube and we'll get someone to reach out to book a meeting in with me to talk through your specific situation and or ideas around what a value add strategy can look like, because it's a great way to artificially increase the value of the property without just being so reliant on the market conditions. But there's so many different ways you can do it. So,
hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. The March edition has just dropped, and you can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. Let's touch on the month's performance from a capital city perspective. We won't go like a deep dive like we usually do, but just touch on the highlights. And I think there's a couple of data points that you and me have been discussing with our economists over the last couple of weeks, and we thought it'd be interesting to address to the audience. Looking at the figures though, Perth leading the way again at 2.3%. All the big players who've been making the moves over the last 12 to 24 months. Brisbane at 1.6, Adelaide at 1.3, Hobart still up there at 1.2, and then the big one was obviously Sydney and Melbourne not seeing any growth off the back of one interest rate rise, and obviously the sentiment at that time with an incoming interest rate rise, which we've now already seen.
It's probably not too dissimilar to what we predicted at the start of the year, Reece. Like we did say, the strong movers are going to be the Perth, Adelaide and Brisbane and Darwin.
Darwin actually completely came off a cliff, 0.2%.
Okay, that surprises me. And that probably will have a lot to do with the change in sentiment. And that's why our sentiment data that we're going to talk about today, I think, is probably the most important data sets that we're tracking. And obviously this is data that we self-source because sentiment moves markets. And data, people don't realise, there's a lot of data out there and most of it is delayed anywhere from a month to sometimes 6 months, where our sentiment data is live and we're talking within the last hours, if not the last few days. So it's really up-to-date data which tells us exactly how markets are feeling, how their behaviour, what's the psychology around the buyers, and buyers is the demand side of the equation. So Darwin, that is an interesting stat, and I think that's based off the change of sentiment. The investment sentiment potentially dried up, and that market has been moving predominantly, if you speak to buyers agents on the ground and real estate agents on the ground, predominantly by investors. We're talking 80-90% investment activity. So interesting.
That is very interesting, actually, because it's probably died off a lot quicker than what we thought. Not sure if the sentiment is around, with these incoming potential changes to negative gearing or capital gains tax exemptions, which, Darwin is generally a place where landlords that have got multiple properties are probably honing in on. So I wonder if that's probably a core reason that's slowed down as well.
Yeah, and there's a lot of uncertainty. We're going to talk about that today, Reece, and what that looks like for our listener base and our clients and everything else. And one thing you'll see, I think it just echoes and reinforces what to buy, which is own-occupier locations, not where the droves are going in the investment activity, because these are the moments, these are the periods of time where those markets are going to get smashed, and you're going to see your regional Queensland markets come off a cliff because all that investment activity is now starting to come out. You can see it already. Days on market is shot up. If you could look at a graph like a ski ramp, it's days on markets are flying. You're going to see vacancies increase, and you're going to see, I think, quite a steep fall in valuations as that market comes off, by the sounds of quickly as Darwin.
What's your thoughts on the Perth market? You know, we've done a lot of podcasts over the last 12 months on Perth. We haven't really spoken about it at too much length on the most recent month's podcast. 2.3%, and you know, this year done well over 6%, and stock availability is still at all-time lows, although it's creeping a little bit up, still historic lows. Do you see the sentiment changing in the Perth market at all over the next couple of months?
Sentiment's changing globally. So no one's immune. No city, no town. Every region in the world at the moment is carrying negative sentiment. But if you look more locally in Australia, it's compounded by this interest rate environment. So we've got a situation here where there's a war taking place, which is obviously driving prices of fuel, diesel, etc. And that has huge implications, not just in that specific commodity, it also has larger implications because everything requires transportation, right? So food or goods, water, people don't realise that these are the sorts of implications that can have. So inflation is looking like early predictions is going to rise. The only lever our RBA can pull is interest rates. So now everyone's forecasting 3 to 4 interest rates. So what does that do? Negative sentiment. So already you've seen in the last 7 days, Reece, speaking to agents across Australia, is home open numbers have halved. And in some instances, you've seen 10 to 15 groups go down to 1 or 2 groups going through a home open. So it's amazing, even when the supply and demand imbalance is so out of whack, that these markets can so quickly change on the back of sentiment. What I've said to our clients, and you've heard me say it to the team, is, you know, not to want to take advantage of what is a really serious global and, you know, an economic uncertainty. For me personally and for our clients, finally the pendulum has shifted towards the buyer. It's been such a selling market now for the last 3 to 5 years, where for the first time, you know, in recent history, I think this uncertainty, this fear, this, we've seen it so many times take place in different forms. COVID in the most recent example, that it is now finally some good buying conditions. We can see in properties that are selling under the quoted amount. I think I read a statistic this morning that 75% of the Melbourne market is selling under the guided price. Fantastic as an investor trying to buy well, right? You want to be greedy when those are fearful. You want to be fearful when those are greedy. For me personally, this is a time where you are going to get better deals as an investor than you would have got 2 weeks ago, 2 months ago, certainly 12 months ago. And it's likely the prices you're able to accumulate assets in this period of uncertainty is going to look like extremely good buying in potentially 6, 9, 12 months, right? And that's what we're going to look at.
Those that are watching us or viewing us, there'll be a graph that will be coming up on the screen right now, but I'll just talk it through for those that are just listening on the audio. This is our PropStack data looking at house price from March 2020, which is when the COVID lockdowns happened in Australia. And you can see every market, that's when it started to go on an increase. So arguably the most uncertain time was where all markets started to see a bit of an uptick. Yeah,
the difference is at that point in time, the government slashed interest rates and the market went on a tear. But you're 100% right. There's always a reason, and the activity at the moment, we've had just recent emails. A client reached out this morning on the way here saying, Lachlan, our strategy was to expand the portfolio to buy a property. What about all this uncertainty, the war? I think I'm going to put it on ice. And I was like, just went back and had a look at some emails that the period that COVID hit, and it was just almost copy and paste of the same email. It's like, COVID's hit, we're really uncertain, we think we're just going to sit on the fence. And some people sat on the fence for 2 years, right? Some people sat on the fence for 3 years. There's always a reason not to do something. But in recent times, the best time to buy was that 2-month period after COVID hit. And I was fortunate enough to get into the market at that point, and those with the courage, to do so, which it's not easy. It's the hardest thing to do when every headline, every person you speak to, your local barber, the guy at the pub, the bloke down at the local bowls club, are all saying the world's about to fall apart and that you should be selling everything. And then you got someone on a podcast or a property advisor that you've never met before saying, actually, history would tell us this is probably the better time to buy. It can be hard to comprehend, but I look back and, I wish I had bought 40 or 50 properties in the 2 weeks post-COVID, because that would have shown, at this point in time somewhere between 120 and 150% growth. Not saying that that's what you're going to see off the back of this war, but I've already noted Perth locally an example that a client of ours secured a property for 1.25 in the northern suburbs that without a doubt 2 weeks ago would have sold for 1.4. Okay, that's good buying. If things do return to normal, which is quite probable, we know history will say that there will be a time that we call quotation normal again, probably not in the too distant near future as quickly rates go up. The RBA have spoken about that our economy is flat, so we're a stagflation economy, where that is the economy is flat if not going backwards, but interest rates are going up. That's not a good thing. So they're fearful of a recession. They don't want that to happen. So yes, they've got to increase rates quickly because they don't want to repeat what they did in COVID, left rates stagnant for way too long. They've addressed that, so they want to curb behaviour spending, so they're going to increase them quickly. But the moment that inflation's no longer a risk and they feel like it's handled, rates will come off. And then what happens when rates come off, Reece? Money becomes cheaper, but more importantly, sentiment changes. You start to see headlines. Properties become easy to buy. It's more affordable. People have access to more debt, and you see markets run again. So do I want to be buying property when rates are coming off and there's stampede of investors trying to get into the market? And I'm competing with, hundreds, thousands at home opens, 30, 40 groups? Or do I want to buy when there's a bit more, there's some headwinds, there's some negative media around it, but I'm only competing with maybe one offer to two offers compared to 10 offers? I know when I'd rather be buying, and that's when headwinds are in play and the headline media is negative, not when there's tailwinds and interest rates are coming down.
Speaking with a top real estate agent in Perth who was telling me on average 7 to 8 offers per property that he was listing, and within the last 6 or 7 weeks, even before some of the second rate rise, he's now saying he's likely to get two offers on those properties. So, a lot of those Perth people that have been missing out for months, years, if in some cases, then now is probably a little bit more of an opportunity for them to get into the market.
Absolutely. And I'm personally now was sitting on the fence, Reece, because the market got too hot to buy across Melbourne inclusive. But now we're starting to see some good deals come across our desk that weren't there 2 weeks ago.
Any tips for those buyers in areas like Melbourne or Sydney, where it's an auction-driven market? Anything that in these types of market dynamics that change, where you can be a bit more aggressive and get a better deal?
It's a really good time to, I don't want to say, because there's people out there that are hurting that need to say, don't want to look like you're taking advantage of that, but our job is, to our client base, is to educate them on how to buy and how to buy well. And it's a good time to stick your teeth in and get a really good deal. So I have one that I was working on over the weekend, Reece, and obviously I have one of our team, our buyers agents representing me at auction. I just said, pass it in, let it pass in. Do not participate at the auction. Do not give the seller a hope that there's a buyer out there for this property. And there's that awkward silence. The auction starts and there's no bidders. And he goes, mate, I think we could offer, quite a low ball here. And I said, do not put your finger up. And he didn't, stuck to my advice, because then we're in the room or a conversation with the agent. There's no interest. There is no buyer out there. So instead of going, putting the finger up, we thought that property's worth 125. Could have put an offer at the auction at 115, $100,000 under ask. All of a sudden we're starting that conversation at 105. And they're going, well, that's ridiculous. The reserve on this is 1.2. Well, was there an offer on that, Reece? There was no one participating. The best time, and if they do need to sell, be greedy, be pushy, because you're in the ability. First-time buyers can actually take a bit of a stance in the market. Is this small moment in time? And it might only be for a month. Could be 3 months max. But it's a moment in time where buyers, for the first time in a long time, have some power in the negotiation. So roll up the sleeve, flex the muscles, and really try to get the best deal you can.
Looking at the latest data, kind of goes through house price growth by capital city, breaks it down into top 25% medium house price, middle 50%, bottom 25%. But the interesting point on the data across the board was that top end is coming off every capital city. Melbourne and Sydney, it's gone backwards. So down 1.5% in the last 3 months for both capital cities. So that's driving the overall medium house price down. And then the big performers like your Perth, your Brisbane, your Adelaides, almost half the growth of what some of the lower percentage, the lower medium house prices, I should say, are doing in those areas. Is this an opportunity, do you think, for those higher price range in buying conditions, or do you think it's going to come off even further in the next couple of months?
Yeah, at the higher price points at Reece, it's the pond's a lot smaller, right? So there's less buyer activity. There's not the pool is not as big, so that's naturally going to hurt in times of more uncertainty. Strong markets like Brisbane and Perth, sort of there's still enough activity and the economy's so strong, particularly in Western Australia, and the supply is so tight, I just don't think we're going to see the same impacts as we're going to see in a Melbourne or a Sydney at that higher end, just because we're seeing those markets come off. Sentiment is so low, and somewhere like Melbourne, where the economy has suffered over the last 4 or 5 years, I think the top end of those markets are probably going to hurt a lot more than Brisbane and Perth. There's just so much stability, and there's so little stock. There's no sellers in the market. Perth, for instance, 30% of the stock is selling each week, which, regardless of sentiment, when demand is so much stronger than supply, to that point where there's no market in the world that I've been able to identify where 30% of the total stock available is selling on a weekly basis. That's a critical undersupply. So regardless of all this noise that we're seeing, the fundamentals are going to support potentially price growth in all areas of the market, be that entry level, middle or high end, because of that imbalance in supply and demand.
Demand's interesting because there's some recent migration data that's just come out in the last couple of weeks. Some big figures here as well. So from a net arrivals perspective in January 2026, 57,270 people. That's a record.
That's a record in history. So they wonder why we've got a housing problem and the government want to tax investors, yet 57,000 people arrived in Australia in January 2026 with the intention of staying here long term. And you wonder why we've got a housing crisis and they're not doing anything to bring on any supply, Reece. This is what baffles me. Let's tax investors, yet let's let almost 60,000 people into our country with the intention to stay for 12 months or longer. We don't have a housing crisis, Reece. We've got a migration crisis. We've got a government that is letting far too many people into the country that they haven't provided accommodation for. I'm completely, open, and we know that migration is really, really important for economy and stability of our economy moving forward. But not if you're providing a supply solution. And this is the problem. So up until January 2026, we let in almost 500,000 people. Is that right?
Just under 500,000, correct.
Almost 500,000 people into the country in the last 12 months, up to January 2026, the highest ever recorded in history. In the tightest supplied market that Australia's seen, with the ability to bring on new stock, never been more difficult under the current building restrictions and the inability to get materials. So you look at those fundamentals, Reece, and it's mind-boggling who's running our country and how they're trying to go about it.
The big one here as well is temporary visa holders at 2.98 million, which is a record high, just 5% year-on-year growth. And a lot of those temporary visa holders are going to be taking up the rental stock as well.
So we're going to have less rentals because they're going to try to tax investors, and they're going to bring more people into the country to absorb what available stock is there. And you're going to wonder why the housing crisis is going to get worse before it gets better.
Let's go through the Folio Sentiment Index, which I've been pretty excited to talk about today. Those that are listening, I'll talk it through, but there's going to be some visuals up here on some of the graphs. And it's going to be fascinating to do this in a couple of weeks' time once we've got the March data, because we've had an additional rate rise over a war in Iran gather some momentum. We've had the petrol prices, we've had the negative gearing come out as well. So it's probably going to change even more in the next month. The biggest one out of this one here was looking at investors' biggest concerns. So there's interest rates, prices falling, cash flow, access to finance, or no concerns at all. Interest rate concern in January was 13%. Now it's at 30%. I guarantee you that'll double even more in the next months. Cash flow has remained steady. Prices falling, has slightly dropped down, and so is access to finance. So the overall thing is, within a month, we've already seen, this was pre the second additional rate rise and pre the war, we're already seeing there is a bit of a concern now with interest rate rises amongst investors.
Yeah, it's not surprising because that's all you're reading about in the media, and all the news out there is it could be 3, 4. I read an article the other day, there might be 5 rate rises this year, which nothing's ever as bad as what it appears and nothing's ever as good as what it appears. So this is a moment in time, Reece. We've been here before, and really quite recently through COVID. We've also, now with access to so much media at your fingertips, and a lot of people probably watching or listening to us on their phones, you'll jump off this podcast and you'll read 3 or 4 articles that will take you on completely different tangents. But the reality is, if you are buying in markets where demand outweighs supply, this sentiment that we're seeing is a moment in time. And it's great to get that data because it's not surprising, because we're seeing what the people that are listening to this podcast, what they're feeling and their behaviour towards property is taking place in the marketplace with home open numbers and offers on properties, which is great for us. And it's like, if I could overlay when to buy across our sentiment data, when it's at peak confidence, I'm out of the market. The moment confidence is at its absolute all-time low, as an investor, I'm buying into the market, which is counterintuitive to what most 99% of the population will do.
This investor index that we have, this is off the back of the investment report. For those that are listening, they sign up to it, answer 5 questions. That's all they got to do. They get access to the report. We've had over 1,000 people register for this now, so it's a big pool of people that we're reaching out to. What we did break it down as well was if they were a first-time investor, they had one in their portfolio or they had multiple. So that way you can get an understanding of what type of client is registering the report, what the sentiment is for a first-time investor versus a more experienced landlord. Now, the next graph I've got is a breakdown of what I just mentioned there in terms of the concerns: cash flow, prices falling, interest rates, access to finance, no concerns. The reason I brought this one to your attention was it kind of backs up what you were saying earlier about the market conditions. So those first-time investors or people with one property, their biggest concerns are prices falling and interest rates. 2 properties plus, their biggest concern clearly is access to finance. So there's no concerns around the rates or prices falling. I think they're seeing that as more of an opportunity. It's purely how do I keep going? Access to finance.
Exactly. And it's probably those that have invested, done well out of property, probably slightly more astute, more educated because they've been investing for longer, see the opportunity of taking advantage of this moment in time versus the first-time investor that's like headline media. I'm just going to go with the droves. It's like almost like a tide up and down with the waves. And it's no surprise in that data because you've got an educated, potentially more seasoned investor seeing this moment in time as an opportunity. Where have you got the rest of the marketplace? People who don't have access to property seeing the opposite, that this is a really bad time because confidence is down and sentiment's low.
We also tracked via what state they were in as well. So on that same graph, I won't get your commentary on it, but just for those listening, cash flow, New South Wales and Victoria, the biggest concerns. Obviously, they're markets that are a little bit tighter from an affordability standpoint. WA was access to finance, really. So there wasn't too much of a concern in terms of cash flow for people in Perth. The next one I want to talk about, though, is, and this, again, is very similar to what we've been talking about earlier, and I'll be interested to see what this looks like next month, is it a good time to buy in terms of this current market conditions? So those that are first-time investors are still pretty positive, 48%. One property on the fence, 50-50. 2 properties are very confident, and there's a huge gap there as well. So it's really shown those seasoned investors aren't getting too spooked out of what we're hearing in the media at the moment.
Because they've likely seen more than one cycle. When I say that, if you've owned 2 properties, you've probably either purchased before or during that COVID period. So you've been here before. You've been in times of uncertainty and pulled the trigger on a purchase. Where those that haven't, I can understand your fears because you don't know what you don't know, and if you haven't been through times of uncertainty, it's really hard. I get it mentally. Hardest thing you can do is to go against the grain of society. It's, history say it's very uncommon, unprecedented, you could say, Reece. But that's why the seasoned investor who has done it and it's worked well for them have sort of got that, what do you call it?
Confidence?
Yeah, they've got the confidence to be able to do it again.
Well, I mean, then that's the last graph. It actually breaks it down from a confidence score factor, which is a scoring metric that we've created at Folio, and New South Wales being a very experienced investor state with the amount of growth they've had, and we know a lot through the clients we help from over in Sydney as well. They're very used to investing with outside their backyard. They by far had the highest confidence in investing and buying in this market at the moment. So that's our first take at the...
I reckon what was Melbourne? Melbourne would have been the lowest. Anyone that had property in Melbourne?
Yep, Melbourne's the lowest.
Yep, and that's no surprise, right? If you're in a market that hasn't done much, it's very hard to look outside the box, and that was echoed in our last podcast that went out on Tuesday. Reece, was the Melbourne update, just echoing the sentiment on the ground.
So big couple of weeks, I guess, across the property industry and Australia's economy as a whole. Be interesting to track this data moving into...
It's a topical time. We've got heaps happening. You've got your May budget, you've got GST reform, you've got capital gains reform, you've got negative gearing, you've got mass migration still coming into the country, you've got One Nation doing their thing. There's a lot happening, Reece. There's a lot happening.
Guys, send in your comments. Send us any if you disagree with anything Lachlan's saying, if you've got any feedback in the market yourself that maybe looks a little bit different to what we're saying in terms of some of the on the ground.
And what you're feeling, the sentiment data, if you haven't filled out a survey, what are you feeling? How do you see the market? Do you think it's time to be bullish, or you think, what I'm saying is incorrect, I'd love to hear from you.
Absolutely. Yeah, that's a big point, actually. This sentiment index that is from our investment report, we've had over 1,000 people register, which is amazing.
Yeah, thank you, guys.
But we get a lot more than 1,000 people listen to this episode. So those that want to have access to it, make sure you click in the link on YouTube or Spotify to register for the report. We do ask 5 questions, which is the sentiment index that we've just been talking about. We'll never ask that again of you. It's purely to track them on a month-by-month basis. You've been listening to Follio Property Podcast.